What's going on, ladies and gentlemen? Michael Silva here. You're watching the Figuring Out Money channel. Welcome to 2025. This is the first video of the year. And as we kick off this trading week, the markets are already presenting really a fascinating mix of signals. So in today's breakdown, we're going to start revisiting some of the key developments that set the tone for the week. Then we're going to dive into some of the intermarket correlations to uncover some potential opportunities that are hiding in plain sight. So we're going to also dive into the bullish percent charts, which are hinting at the potential for market relief. And alongside of that, we're going to dive into some of the signal charts that are painting a more cautious picture. From there, we're going to shift our focus into the current market conditions, dissecting the critical gamma flip line and the direction of the 5-day moving averages. Finally, we're going to be wrapping it up with a detailed analysis of the S&P 500 to really tie it all together to help you navigate this dynamic environment and hopefully get some clarity. If you haven't subscribed to the show, make sure to do so. Before we get into today's show, I got to thank my patrons that support this channel, that keep it going, that got me to leave my corporate job to do this full time. It's only $9 a month and it gives an incredible amount of benefits, including some trade ideas, which, by the way, it's not an alert service by any means, but we do set up a lot of trade ideas. I give my watch list, the tight list, which are stocks from the watch list that are contracting, expected moves, a comprehensive set of query bots from TradyTix, including the query bot where you can type in commands to get your own charts and data. It's really impressive stuff. I'll talk about the market net flow, which was great insight for today. I give the zones document. You get access to the Discord, the community as well, obviously. I got to thank my partners, Interactive Brokers. Make sure to check out that link too as well. If you want to start fresh, start with a new broker. I use them. I use Fidelity. I use Interactive Brokers. Interactive Brokers offers a whole host of products that are free too on top of that, including a bunch of different courses from beginner to advanced. They got podcasts, insanely good blog that offers up really good insight that you probably should take a look at there too as well. All right, let's get into today's show. All right, ladies and gentlemen, welcome back to the show. We're looking at the 11 sectors that make up the S&P 500 right there on the right-hand side. Tech leads the way. Go tech every day. Communication services right down there. And then towards the bottom was more of those risk-off type assets, right? Consumer staples, utilities. And we have real estate down there too as well. So it was a tech-led rally. S&P 500 was up a whopping 55 basis points, but NASDAQ was up a whopping 1.24%. The Dow Jones remained pretty much unchanged, just slightly down. Now, if you were watching this stuff intraday, what you would have noticed was started off with a nice gap up, and then the market faded into oblivion throughout the rest of the day. And there was actually some really good insight throughout the trading day to let us know that this was a strong possibility of potentially happening. And that tool is market net flow, one of the ones that I had mentioned earlier on the query that you can actually pull up. Now, it doesn't give you convergence, it gives something called momentum, and it gives you these lines here. But basically what this was telling was the cumulative net premiums for puts were rising throughout the day, while the cumulative net premiums for calls were rather dropping as the market was pricing higher. And this divergence here really started to converge right at about this area. And from that point on, the market kind of just sailed off into the sunset a little bit to the downside. Now, that's not necessarily meaning that the market's going to come in fully, but this was just the day's flow. And if you knew this, you would probably understand that, hey, maybe I should wait for some confirmation, something more bullish, to be buying these specific dips, right? We saw a nice big rip, and then the entire day, it really just kind of faded. Semiconductors was one of the strongest performing sectors, which is not on this list here specifically. It's in the technology sector, as that's kind of how it works here at stock charts. But semiconductors was up 3.32%, breaking out of this tighter consolidation. So a big move here. It'd be nice to see some consolidations and potentially follow through to reset up here in 2025 if you missed that opportunity. Now you can look at the expected moves. We're going to update these towards the end of the episode. But you can see here, we started above the daily implied move. We worked ourselves up to and around the weekly expected move. Didn't quite make it there. And then we faded back in. Remember, 68% of the time, right? If you're thinking in terms of a distribution curve, we finish within these expected moves. And take a look. Where did we finish? We finished, just so happens to be, pretty much directly on that daily expected move. So the market did exactly what the market priced in on Friday for today's trading session. Now, I'll do more analysis on this because this does not look bearish to me as it stands, but we'll do more analysis on this one a little bit later in the S&P 500 section. The Qs finished within its zone, which was below its daily implied zone, expected move for the VXN, the volatility index for the NASDAQ 100, and slightly above its daily implied move, which is based off of the options chain 0-date expiration. And then IWM, you can see here, we got into the daily expected move zone over here and we kind of faded, coming back to and around really unchanged on the day pretty much. Now, tomorrow we do got some big data coming out, so it's going to be important to pay attention to these, what's expected in the market. This is 30 minutes into the market open. We got ISM services and JOLTS, and these are big reports. And we still got more big data coming up later in the week. We got FOMC minutes, okay, but then we got non-farm payrolls, unemployment, and we got Michigan consumer sentiment, which is the preliminary January, which could potentially have the impact. It could have a small impact on the market and order flow. Now, as we go through the remainder of this week, I wanted to bring up the almanac because this is kind of interesting stuff. So I just took a picture of my almanac. This is a pretty bullish week overall, right? So January 6th just passed. Tomorrow's the 7th. And you can see here, based off of seasonality in the month of January, dating back, I think it was, how long did this thing date back to? I think to 2003 was the statistics, and they look at the days that are, they put a little bull over here, you can see, that are 60% in the green. So Tuesdays are typically 60% showing a positive gain greater than 0%. Wednesday, it doesn't have that, but then Thursday you can see that the market's actually closed Thursday. So this wasn't updated, but this is also because of for Jimmy Carter, the market's going to be closed on this specific day. So maybe perhaps we'll see what happens there on Wednesday. And then Friday also has the bull. So this week, right, many times the market in this part of January closed 60%. Now, what can you do with these statistics? Pretty much nothing. But if you are bullish and you got to see this type of stuff, right? If something like market net flow is bullish throughout the day, this could mean that we could potentially have a trend day back up to the weekly expected move at some point, right? It's not a guarantee, but it does help knowing that, hey, it's a bullish week, typically from a seasonality perspective. All right, so let's get into the intermarket aspect of things here. What really drives markets before it comes into various equities is down on the day, which is a new 52-week low, I believe. It hasn't been this low or hit a low since, well, I guess dividend adjusted, it'll be a little bit different, but we haven't seen a low since late May of 2024. Okay, the last time we really talked about this was this diamond pattern, and when you measure a move, it goes up to and around that 95, which we just about came into right around there, and then the entire move got faded there. Now, what I find interesting here from a correlated standpoint, from just an interesting chart, the one that you see on the thumbnail here, is this top line is the S&P 500 relative to TLT. So when the line goes up, it means the S&P 500 is outperforming bonds. Okay, that's pretty typical, right? However, when you look at just the SPX, right, as absolute just chart of SPX, you can actually look for divergences here. So when the SPX outperforms TLT, so it means that it puts in goes from this point to this point, a higher high, right? Higher high. But this chart, which is the SPX, does not confirm it, and it puts in let's do this, like that, a lower high. That's what I'm highlighting on this chart. I'm showing you the times that this has happened dating back to like late 2021, right? That's the only data that I kind of went through really quickly. Now, what's that look like? Well, okay, so the divergence happened here, the market pressed down a little bit. The divergence happened here, the market kind of fell down a little bit, and same. Even right over here, right? Boom, the market went through a correction. Here, right, we saw a little bit of a pullback there. And why I'm calling it out now is because you have this high, they're lower, but you have this same area on the chart, this low, this high, and a higher high is going up. So this is going up, this is going down, which does lend kind of like makes you question, go, I wonder if this divergence is going to result in potentially more downside in the S&P 500. Now, to negate that, you would want to see the S&P 500 break to new all-time highs. That would negate this current divergence taking place. So I think that's going to be an important one to watch moving forward. Or if we are going to pull back, this could be just one of those warning signs that we're currently seeing, right? And it's typical because when you get a rising yield, right, especially with like a rising dollar, it hasn't been good for markets, which I'll show you that chart momentarily. The dollar came off today, but it did find a little bit of a bounce. There was news around Trump's and the tariff confusion, which saw the dollar kind of come back to life. So it breathed a little bit, came back. Now, when I think about this, I mean, I feel like the market from October priced in tariffs. So I think that what we're going to see here is potentially noise, because typically, like in 2016 going into 2017, the dollar rose, but then when Trump came into office, the dollar fell 2017, basically the entirety of the year. So if Trump wants a similar situation like that and talk about markets and so forth, I mean, the dollar would have to weaken. And if the dollar weakens, well, that could be good for all various types of assets, right? So the dollar, right, has been going up. The 10-year yield's been going up. That puts pressure on the S&P 500. Whereas if the dollar fell for a year and the 10-year yield kind of came off or chopped around, it came off, well, the S&P 500 saw some pretty positive performance there. Okay. Moving on to some interesting other intermarket stuff. All right, the bonds, right? We might not know where the yields go, like the 10-year yield, which is the candlestick chart, but sometimes oil can be a leading indicator to tell us where that actually might go. And if you look at oil, right, it peaked over here, this black line, it came off, the 10-year yield followed a couple weeks later, started coming off. Oil found a bottom over here in September of last year. Boom, we started rallying. Guess what? A few days later, the 10-year yield started following pace too. Oil kind of found a little bit of a top here, started coming in. And guess what? Shortly thereafter, finally, the 10-year yield backed off a bit there too. And in a recent trade, oil's been going up, the 10-year yield's been going up. So if oil potentially takes a little bit of a breather, it could tell us that we'd have more consolidation in the 10-year yield. Now, if we just look at a chart of oil, it recently broke out of this consolidation pattern. It came into a declining 200-day, so a pretty strong move here in a short period of time. So to see this digest a bit would be a positive. I would imagine this would be a more positive effect on the 10-year yield to come down, right? That's how I would kind of read into that in this current moment. But just be cautious that oil already to start the day or start the year, right? We've seen a nice little uptick here, and oil, higher price of oil is inflationary, and copper, higher priced copper would be inflationary. Copper is known as the economic metal that has a PhD in economics, or whatever the heck the saying is. But you can see we actually ran into this lower trend line here with copper, right? And we're kind of coming back within that. So is this just a little bear trap, and is copper going to go higher? And then this here will present opportunities if you understand correlations to various countries and various equities, whatever the case may be, with copper, which brings me to FXI, right? So FXI is down here, and this is the 20-day correlation, and this is copper, right? And what you'll notice here is, just take a look, right? Take a look. It doesn't take a genius to see this, but you see this big move up in copper, right? What does that correlate with? Well, big move up in FXI. And then you see this kind of inverse head and shoulder kind of pullback. You see this inverse kind of head and shoulder pullback. Same situation going on. Now, today, FXI was down almost 1.5%. Is like 1.32% to the downside. Copper was up 2.15% with that positive correlation in place pretty much all through 2024. Actually, it had a positive correlation, other than a small hiccup there in February. Came to a negative correlation for about a week. So what I'm thinking here is, if copper is going to start moving up, I think that might open the door for some good trade within some various China equities, potentially KWEB, FXI, whatever the case may be. But I think that that's going to be important to watch alongside the dollar, right? The dollar, if the dollar comes off, there's also an interesting correlation there, which I don't have a chart for. But what I can say is, if you go back to 2017, when the dollar started coming off, when Trump came into office, You saw immediate boost in some various China equities. So I feel like that could be something to potentially play out in the near future, but you got to just manage that risk as you see fit, because playing with China equities, they're pretty volatile, and you could wake up the next morning here from the States and you could be down significantly, right? They're very gappy. Gold is at its lower trend line in this larger consolidation pattern, right? If we know where the dollar's going, perhaps we know where gold's going to go. So if the dollar's going to come off, that could very well be beneficial for gold in 2025. Speaking of other metals, silver was up 1.72%. The miners were down today, and there's also a very tight correlation here. If you look at the 20-day correlation, it's at 93. Right? That's a very strong correlation. And you look at these two charts, you're like, well, they're the same chart. But what I'm calling out here is that divergence. So if miners come off, but silver is going to start breaking up higher, this could be an opportunity. And I'm not a really big fan of trading the miners because they are a lot more choppy, a lot more volatile, hard to get better reads. Some are illiquid, whatever the case is. But if you size correctly and you manage your risk, there's opportunities within this stuff. If I look at the bullish percent chart on a weekly basis for the gold miners, you can see that we actually had a negative divergence forming here as the market was pressing higher. And now we're coming into an oversold condition on the bullish percent chart RSI. You can see we had a bullish divergence here, and that led the market to go up to those highs. You saw a bullish divergence here, which led the market to move up higher. You saw a negative divergence right over here that led the market to sell off. So perhaps if silver gets some steam, I mean, this isn't, as far as the reading goes, it's not really that oversold, but the RSI reading is kind of creeping into those territories. So perhaps that could be a potential opportunity in the near term here too. I want to look at some other bullish percent charts that are kind of showing more positive light on the markets to see these bounces. And then we'll get into the signal charts, but these are the bullish percent charts for the NASDAQ composite. I'm going to run through a bunch of them. If you don't know what the bullish percent chart is, it's the percent of stocks, that's what this number is, that are on buy signals within the index based off of the tic-tac-toe point and figure charts, okay? So this is for the NASDAQ composite. It says 50.54. So 50.54% of the stocks in the NASDAQ composite are on buy signals. The NASDAQ composite is comprised of 3,000 plus stocks. And I like to apply an RSI and look for divergences. And in recent trade, right, we started getting oversold, right? Coming into 2025, we were oversold. And you saw this low and a lower low, a low and a higher low there, which is a positive divergence. And guess what? We're working out of these overextended areas. So that's for the composite. The NASDAQ, same situation. You have a low, a lower low, positive divergence. Guess what? We're seeing tech lead the way today in the last couple of days, and we're working out of those oversold conditions. BP/SPX, same situation, been oversold, saw the positive divergence, working ourselves out of it. The NYSE bullish percent index, still in oversold condition with the positive divergence here, as market's been kind of just flat, also working itself out for the most part, trying to work itself out of these oversold conditions. The discretionary sector is currently in oversold condition. Remember, if you look at like XLY for the consumer discretionary, there's only like 2 stocks that really drive 40% of that equity, that spider ETF. The bullish percent index for the technology sector, we had a bullish divergence. We had a low, a lower low. We had matching lows over here or slightly higher. And guess what? We worked ourselves out of that divergence in oversold condition. The industrial average has a pretty clean one right now where you see a low, a higher low, okay? And then you see these matching lows over here as the market hasn't really worked itself out, but you can see that we do have that positive divergence in the Dow Jones Industrial Average. So that could be one to potentially watch here in the very near future, is the DIA, or however you may look at or trade. And it could be YM, right? Futures, whatever you trade. Okay, let's go into some signal charts. So those ones would be the more telling us that, hey, we're getting a bounce because we were oversold based off of these charts. Now there's some signal charts that have been giving us good insight, and a couple that are not the greatest look for the markets. And I went over one of them already, and that was this one specifically of the SPX TLT. So we're going to skip that one, obviously, because we talked about it. But this right here is looking at back month versus front month volatility. And this helps us really get good insight, right? So when we started getting extended up here, we started saying, hey, okay, if we're back month is 20% higher, which is what that 1.2 means, higher than the VIX, this could be a time where we consolidate or pull back. We've been saying this for a long time. And here you go. So we pulled back, we consolidated. When we got really down here, like we did in August, right? 0.88, that's a pretty crazy reading. That right there tells us, okay, this is getting a little too frothy, too fast. And now we can work off some of these levels or kind of consolidate once again or bounce. And we did bounce and then we came back in. And what's the reading now? It's at 1.12. Now, I personally would like to see it under this 1, but it's not there yet. So it's really just not giving us much in this current context. Another one that we talked about was the put to call ratio, applying a 10-day moving average to it. And we talked about it right when it came into here. And so we had a lot of confluence of signal charts telling us that things are getting a little frothy here. The last couple of times that we reached into this kind of lower reading, you can see here was in July to August of 2023. Then in 2024, July to August, same situation. We had a 9.8% pullback-ish, right? 6.5% pullback-ish, right around there. And then since we've reached into this from the peak to the trough, as it stands, about minus 4.2%. And that does not mean that we can't go up from here higher, which would mean that we'd probably see more market turbulence, right? When the put to call ratio kind of elevates like that. And then we start to look for it to go back through. And if it goes back through, it could create actually potentially good buying opportunities. But each of these times, you can see the line went up through that 1.0, and then it started crossing back down, which offered up some good insight to potential rallies there. So we'll see here if this wants to come back down and then back up, or if we're going to kind of keep on creeping up here in the near term. Another interesting chart here is looking at a couple of indicators, the summation index for the NYSE, and then also, which is the NYSE Summation Index, and the NYMOT, which is the NASDAQ McClellan Oscillator. And something that I noticed is when we take the Summation Index and it crosses through the 0 marker at about the same time we get a minus 300 reading, we've actually seen some pretty turbulent things happen in the markets. Now, you can't really base a trade based off of this. I think it's just more interesting than anything. So I'm sharing it with you, but you can see over here, dating back to like 2018, right? This signal kind of crossed, and then we went sideways. And then it did the same thing over here. And we actually ended up kind of going through that Christmas Eve massacre, whatever they call it, going into 2019. Going into the pandemic, we actually saw something pretty similar happen before a lot of volatility took place. We crossed down through 0. This got an extended reading, and it happened, pretty quickly there. Over here into 2022, we got a signal a couple of times, and we went into that bear market. Over here, right, in 2023, we got the signal. We actually went up, but then we came back down, right? A lot of sideways chop. And in recent trade, we got... And I remember there being a fake out somewhere in here too. I'd have to go through it again. But there was a fake out. It wasn't here. It wasn't there. It may have been this one. I can't remember. I can't recall if this crossed down through at around the same time. But if it did, well, we saw some more volatility around in there. But yeah, okay, so continuing on, I just wanted to call out that we did get that signal recently, and the market's kind of just been going sideways as it stands since that signal. So can we do anything with this? I am not going to do anything with this. I just think it's kind of interesting and gives us some insight, and you can stack this with kind of other things that you may be seeing in the markets. Let's talk about conditions. This is where I get a little bit more tactical. I want to start off looking at the current gamma levels here and where the market kind of has potential pins. And by pins, I mean where price can kind of gravitate to and get stuck at. And right now, the key levels to watch would be 5,900 and 6,100. So this would be the put wall. This would be the call wall. So this can act as potential support. This can act as potential resistance. So those levels, I would say, pay close attention to, which on the chart, you got 6,100 right here and you got 5,900 down here. And we're pretty much right there between the two. And you can see the gamma flip line is right there at about 5,960. So we're above it. We're positive gamma, but this is very neutral stance because the gamma flip line, it's going to change. It's dynamic. It's always updating. So when we were right by it, and just be aware anything could really happen here. When we flip into negative gamma territory, that's when volatility typically increases, right? And you can see the dealers, they'll sell into selling, they'll buy into buying. You get that. That's what creates the volatility. If we stay in positive gamma territory, start moving up and breaking from these levels, Then volatility typically comes in, right? This is where dealers look to buy the dip and sell the rip. And that's why I would say, yeah, we can start targeting 6,100. So as long as we're really kind of above this 59.50 gamma flip line, I'd remain bullish up to 6,100. If we start crossing below this, then I'd just be a little bit more cautious and look for potential setups from a 5-day moving average perspective. And if I'd show you now the direction of the 5-day moving averages, right? There's two things I look at for market conditions to whether to know to take my foot off the gas or put my foot down on the throttle. It's the gamma flip line where we stand and the direction of the 5-day moving average. And you can see here we're pretty much green across the board, which means that the assets that we're looking at, SPY, Q, IWM, semiconductors, XPI, they are above a rising 5-day moving average. So SPY, you can see, I have blue lines here too, and those are the anchor VWAPs for the start of the year. And that's a good sign to see that the markets are above that, which would mean what? It means I'm bullish as long as we can remain above these levels, right? So SPY, we saw a nice big move. It's kind of fading off, but it's above a rising 5-day moving average, rather flat kind of, and above a year-to-date anchored volume weighted average price. So even if we were to come down into these levels, I'd be looking for a setup that sets up to go retest these highs and go into 600, right? We can wake up tomorrow and be there already. That's how crazy this market can be sometimes. Qs, same situation. IWM pulling back into around the year-to-date anchored volume weighted average price. Pay close attention to that. DIA, it's a declining moving average, but we're above it. So it's saying more caution than anything. But as we previously shown, the bullish percent chart, it is pulling back down. It's holding the year-to-date. So if we can kind of break from this level, perhaps that opens the door to retest it, and this starts to turn around, and that gives us a potential early entry for an early trend change in the DIA. Semiconductors saw that big move here, so I'd like to see how this consolidates, maybe come back to the year-to-date anchored volume weighted average price at some point, and then go from there. I just would like to see a little bit more consolidation before well, I have some semiconductor stuff on. For adding to a position, right, I'd like to see more consolidation. And I like to see these levels hold. For biotech, we're holding the year-to-date anchored volume weighted average price and above a rising 5-day moving average. So same story goes here. I'd prefer to see us hold above the year-to-date and above this rising 5-day moving average. This brings us to the S&P 500. The S&P 500, we're going to start off with the weekly time frame and really just look at the 5-day moving average on this chart. Sorry, 5-weekly moving average. Right? When we get extended from it, you can see rubber band snapbacks. I feel like we've said that many times, and I'm going to continue to say it. You can see when it got down here, we snap back. We got down here, we snap back. When we got above here, we snap back. When we got way up here from it, we snap back, and we snap back, and we snap, snap, snap. Okay? What is it doing right now? Well, we're basically at the weekly 5 EMA after a week that put in a nice lower long tail here, a nice hammer candle on the SPX, and we're kind of just trading sideways for the start of the week, right? We have still a lot of time left to know what this candle is going to look like. If we start pulling back, look for a potential gap fill, but just be cognizant that that would put us back underneath the weekly 5 EMA. Now, if I zoom out, I still want to point this out that we broke down from this wedge, right, tight price action, and we have this negative divergence. So we broke down, we're coming back a little bit. We could consolidate around 6,000 and set right back up for another big move. I'm not saying that that's not possible, but it's very common to test the 200-day moving average once a year, sometimes twice a year. I'll have to get that data. That's what the 40-week moving average is. That's what it's showing. That's about 5,600, slightly higher there. So at some point, right, this year, it's very common to see a tag or a test, right? I mean, just look at, right? So in 2024, boom, we tested it here. I'm sorry, 2023, we tested it there. 2024, we tested it right over here, right into it in July-ish area. So are we going to see that at some point this year? Well, the weekly chart, you have this, negative divergence playing out for the most part right now. You had it over here in 2020, going into 2022. You had a similar type thing going into the obviously the pandemic, which was a one-off type of thing where we saw quick volatility shocks and circuit breakers and all kinds of crazy stuff. Okay, so I just wanted to call that out from a larger scale. If we zoom in and we look at the daily time frame and look at the expected moves for the week, it's very common to attack the expected moves. This week, it's about 8.45. I also included the month-to-date expected moves and quarterly expected moves for SPY for you, okay? So if you want these levels, screenshot this, zoom in, take a look at the numbers. I have the month to date there and the quarter to date, because if we get to those fast, right, that'd be some good data to know about when the markets reach up to these levels. So right now, as far as the SPY goes, if I zoom out on the daily time frame, I want to just still call out that this little pattern over here that we talked about way back when, right, this cup with handle type of pattern, we broke out of the pivot line. A measured move would still take us to and around 620, and that would be well under the quarter to date expectations. So that means perhaps some of these big megas, the market likes what they see during earnings and brings us up there, right? That's a possibility. But we're not too far off, right? 595 up to 620. Yeah, as the market's kind of just been consolidating here, I've seen some distribution days add up, but overall just kind of chopping around sideways as it's trying to figure itself out a bit, though. So those are some important levels to kind of key in on. I want to get a little bit more tactical and look at the 15-minute time frame and show you the new daily expected moves going into tomorrow's trading session. So as it stands right now, our daily expected move is kind of a zone, right? I'm using two separate pieces of math to get me these levels. 601.38 to the upside for the VIX implied move, 598.92 for the daily implied move. That would be the upper area. Now we are below a declining week to date moving average. It's always more positive, get above that. But this is what I like to see, right? You get this big move and then market comes in, okay? This is a pullback as the 5-day moving average is starting to incline, but it's kind of flat. And then we're above a year to date. So if the market wants to come in a bit, even if it were to come down to the lower daily implied move of 589.34 to 591, that zone, that would be right in confluence with a 5-day moving average, which would probably be inclining at that point. And then the year to date. And that's where I would look for strength and then a higher low. And then I would execute more into. Now I have a position in I'm not trading SPY, I have it in SSO, but I would look to add to the position if that was the case. So we almost tagged the weekly implied move. It's typically a bullish week based off of seasonality, based off the almanac that we showed. It's very common to tag one of these. Now, if we get some data that the market doesn't like, hey, we can be down here. At that point, I'd say be more cautious because we'd be below that year-to-date anchored volume weighted average price. We'd be in negative gamma territory. We would be below the 5-day moving average too as well. But as it stands right now in its context, I look for setups to be bullish. Until that changes, I'll keep my foot on the gas. But when it changes, my foot comes off. It's as simple as that. Hope that helps. See you later.